Welcome to video 2 and decision making. This one here will take you through how to do an accounts receivable schedule and moving through to a cash budget. So in our last session we looked at doing the schedule, but this one, if you look at page 222 of your book, or you've got the spreadsheet, that'll help you through. There are a couple of traps in this that make it quite tricky, as they like to chuck in the exam, so we'll get through that. This is for So Good Sushi. So Good Sushi sells sushi to cafes and supermarkets on credit, all on credit it says. 50% of customers pay in the month of the sale, and because they get a discount of 5%, 45% month following, and 3% the following month, which means the last 2% of bad debts they're going to be written off in the third month after sale. So what we're going to do is do the schedule to start off with, and if we read through, we've got sales for October, November, December given here. We don't need October because that's 3 months later, but we do need November, December. So November's figure is we've got 55,000, I think, and we'll type that in. Then we go 60,000. So that's the stuff we know, because currently, according to this, we're in December, and we're predicting the budget for January to March the following year. So we'll put the predicted sales for January, 70,000. See, those sales have gone up, so it's a bit of a seasonal. People buy more sushi, obviously, in the holidays here. And the last one is 65, 62. So remember, it said that of the sales, in the month of the sale, so of that 70,000, 50% of it is paid in the month of sale, and then we get a 5% discount. So what we're going to do is we're going to multiply that by 95%, and that'll give us how much we receive in January from January's credit sales. Best idea is to go work diagonally down, so that way we use the same process all the way through. So we're going to go equals that one, remember, times 50% times 95%, and then do that in March as well. Great. And then we'll do the previous month. So the next part is that in the month following sale, we've got 45% pay. So again, we're going to do this diagonally and just times 45%. January paid in February is a month later, and February pay in March. Alright, so make sure you've got those ones written in. And the last one, it tells us 3% pay in the second month after sale. So November will be paid 2 months after, is in January. Sometimes you've got to check here because there might be an interest payment or an extra charge. Times 3%. And then what we're just going to do is auto sum or add up how much we got from accounts receivable in each month. So just press pause and make sure you've got all that in. Then we go over here. So we finish this part and we're going over to the budget itself. Again, in this one, like we said in the last video, we write the name that would appear in the trial balance. And these figures are going to be that one. So what we receive in January from our accounts receivable is that figure. Good, so nice, easy to start with. So then we're looking for any other money coming in. Now you won't see it on here, it's a bit further down on page 222, but it tells us that they're going to cash in a term deposit. In the month of March, just reading it says, So Good Sushi has a term deposit of 10,000 that's due to mature in March. So we'll put the 10,000 there. But when we're doing this one, we have to actually add the interest on it as well. So it says interest for the facility, 5% interest, and the term deposit's been invested for 6 months. So we're going to add that on. You can do it separately. The book and the answers adds the two together, but we'll do 10,000 times 5%, and because it's half a year, we'll divide it by 2. So we'll add 250. So in the total receipts, we'll just add up, and that's the first part. So you get quite a few marks for this bit here, because you've done all the working, and probably merit marks over here. Payments, you see there's not too many, so reading in the book, it starts off with wages. Again, that's below here. So it says wages are 12,000 for January, 10,000 February, 10,000 for March, but they've got a bit of complication. 80% are paid in the month of the wages, and the 20% is paid in the following month. So that's the PAYE, or the tax. So we're going to have both wages in here, and we'll put PAYE, although this is not a trial balance thing, it's probably best to have that separately as well. And so the wages figures is, what do you say, we need to take the previous, we'll just do the wages on its own, the 10,000 times 80%, then 12,000 is, and then calculate these ones in your head, 10,000 times 80%. And so what we've got here is equal to December's wages, which are 11,000, times 20%, that's the PAYE for February, December we'll pay in January. That was 12,000. And then it's just 10,000 times 0.2. Cool. Looking at purchases, purchases are paid in the month of purchase to take advantage of an 8% prompt payment discount. So of the month, January is 22,200, and if we get an 8% discount, we're going to multiply it by 92%, or 0.92. February's 2,800. And because you're doing a calculation here, it means you are going to get either a merit or excellence mark for it. Okay, so we've got 3 of them. Purchases. After that, wages we've done. PAYE. There is quarterly rates due in February of 1,260. So because you get given the figure, it's only an achieved mark. Has a term deposit, we've done that one. Has a revolving credit, which is like a giant overdraft. The current account balance is 80,000. She's hoping to have it paid off by the end of summer because winter months are quieter. Interest is 6% per annum, payable monthly based on the closing balance of the previous month. So we'll put interest on loan, and that's going to be equals to 8%. No, 6%. I've put the negative to make it a positive number because you've got a negative figure down here. And then divided by 12 to give you monthly. And you can fill that one across. There's going to be 0 here and here because we haven't got our opening balance. But as we work out opening balance, that one will work out as well. Revolving credit, done that one. there are some other expenses that we need to find. General expenses. So you see general expenses, they're 6,000 a month. But this one's actually quite a tricky one. So it's going to be equal 6,000. Then we're going to take off the non-cash stuff. So the non-cash is the depreciation on there. And you'll read that the depreciation is $900. So minus 900. And minus the bad debts. So this is where you need to do some calculations. So we're going to minus, open brackets. Bad debts, remember that was in the 3rd month following sale. And so for our sales, you'll see that October sales were 52,000. And remember, 2% of it was bad. Because you've got 50 plus 5 plus 3. So we're going to take off the bad debts. It's a non-cash expense. And what do we got? Same for the next month. What do we say? The 6,000 minus the 900 minus, and in this case it's going to be that 55,000 times 2%. So that's all the payments we can find. So we'll write total payments. And add all those up. Press pause if you need to. Our bank account was 61,900 minus 36. So our bank account is going to go up by 25. Our closing bank is equal to our opening bank plus the change. And our opening bank the following month is our closing bank the previous month. So remember these receipts minus payments. Nice, so I can just fill across. You might have to type those in. So it looks quite good. They have 13,863 at the end. Then you get some questions. Advise Magwemi whether she'll be able to meet her obligations of paying off her overdraft by end of March. That's a yes. Describe advantages for having a revolving credit pay off in the winter months. So you were saying that it means that she can go into negative and pay those fixed costs. So that's the end of that one. Our next video is going to be on the cost volume profit or break even analysis. There were some tricky things in that, particularly that general expenses and PAYE, but be really confident in having a go at it, because each time you have to do a calculation, that's going to add to either a merit or excellent mark. Each time you put something in that's told to you, like rates, at least you're getting an achieved mark for that. So you've got to get as many marks as you can in order to get a pass mark or a merit and excellence. So we'll see you on the next video, video number 3. We're going through break-even analysis. Video 4 is going to be looking at some exam questions.